Hi everyone, welcome to this live coverage. As usual, I'm here with Yohay Elam from Forex Crunch and Mauricio Carrillo in the background, doing all that technical stuff that we need to cover the
Hi everyone, welcome to this live coverage. As usual, I'm here with Yohay Elam from Forex Crunch and Mauricio Carrillo in the background.
Hi Mauricio, how are you guys?
Hi Valeria. Doing great. Let's see if we get some Draghi drag or some optimism, some action today.
Oh, wow, yeah, the market is waiting for some normalization, but I'm not sure if he will provide us what we want. Furthermore, I do believe that there's a lot of things to do. We have comments, testimony before the Senate. We have UK election. It's going to be an entertaining day, no doubt, right?
Yeah. Well, regarding Como, we got some kind of preview yesterday, but hopefully the real action will be today. So what are you expecting from the ECB?
Okay, well, you know, we're all rushing to price in the possibility of some hint towards easing quantitative easing today. But the fact is that late May, we got latest preliminary inflation figures, which were quite disappointing. The lower for this 2017 producer price index also was below expected. So overall, I would expect Draghi to keep his sense unchanged, right? I'm not really hoping to get much of an upward tone in his statement. Furthermore, we had some market talks yesterday, right? That there is they're going to downgrade the inflation forecast for 2019, right? So that should not be very euro positive. Anyway, I still believe that there are more chances of a euro rally than a dollar rally because I still see the dollar extremely weak across the board. Anyway, sorry, we're less than a minute away from the announcement of rates that are expected to change, right?
Yeah, we can preview it more in detail after we get the official announcement, which is expected to be no change. And that's in 20 seconds, 15 seconds. There's always a small delay. So,
3, 2, 1.
And no change. As expected, the ECB leaves all its policy measures unchanged.
Yeah.
Interest rate at 0%, deposit rate minus 0.40, and the QE program at 60 billion per month. But now on to the Draghi show. Yeah.
What? Sorry, I didn't hear you.
Now on to the Draghi show. Let's see what Draghi tells us today.
Yeah, dollar is getting a hit across the board. Okay, I'm not sure what's going on. The greenback is seen after the announcement, particularly against the euro and the pound, and the Swiss. Sorry.
Yeah, so euro dollar is a bit higher. Well, jumped some 20 pips. Let's see if there's any special announcement from the ECB. Yeah. Sometimes they tell us that they'll tell us more at this conference.
Yeah, the Canadian dollar, it's an exception to the market. Mostly, okay, dollar change cards and it's higher. Okay. Let me see if we find what's going on. Okay, not really a headline behind this move.
No, but it's surprising to see. Also yesterday, I think we've seen higher volatility. And also now, with the no change announcement, we're seeing a range of some 40 pips on something that was 100% expected. So
the market has been too quiet to range bound. Traders are now extremely anxious to do something. But the Super Thursday, really Super Thursday, is just beginning, guys, because Exit polls from the UK election won't be available until 21 GMT or so, right? That's the time the first polls will be out. So I expect this kind of choppy, volatile movements to stand out for the day, at least until Comey testimony.
Yeah. So, yeah, Comey yesterday told us, he didn't tell us, he released a statement of what he's going to say at the beginning of his testimony. And basically, it's a very juicy statement, basically confirming everything we already knew. There wasn't anything, I mean, Trump looks really bad in this, according to what Comey says, but we already knew that from the Washington Post, New York Times. Sorry?
I was thinking, do you believe that this is enough for an impeachment? Because at the end, it's all about if an impeachment is possible or not. And my personal view is that this is not enough, and therefore losing relevance when trading the dollar, right?
Yeah, well, first of all, we did see some reaction yesterday. We did see dollar yen rise and gold fall. So we cannot say we didn't have any reaction to that. I also don't think there's a danger for Trump for impeachment, but the story continues reverberating through the news cycle, and I think it derails him from the agenda. This was supposed to be Infrastructure Week in Washington, and nobody's talking about it, talking only about Comey. But probably we won't hear the words obstruction of justice today. That will be left to interpretation by politicians. Democrats will say, of course. Republicans will say there was nothing to see here. And in the background, we also have the investigation of former FBI Director Robert Mueller. And he's working without any leaks and very slowly, but eventually you'll have a report, and that could lead to an impeachment. But it could take a year or two. So I think I'm not sure Trump will end his 4-year term, but the beginning of the end will not be today.
Yeah. Okay. Quite a statement there.
Oh, okay, we do have some news out of the ECB.
Yeah.
The ECB, sorry?
Yeah, go on. Sorry.
They dropped the reference to lower rates in the forward guidance. The ECB now sees QE running until, the end of December or beyond if needed, but regarding interest rates, it's expected to stay only at present levels, not go below. They always said present or lower. This was also more or less expected, I think, right?
Yeah. No recent stimulus yet. Bloomberg headline, although I can ask beyond that.
CBC's rate at present level for extended period.
Yeah. So pretty much, the ECB, what everyone was thinking. Then the rhetoric on QE and change, rates and change, and a slightly hawkish stance coming from the fact that they dropped that lower rates in forward guidance, right?
That's, I think it was more or less expected that they'll change this wording. They'll change also when Draghi begins speaking. He will not talk anymore about downside risks, but balanced risks.
Okay, there's a question for you, Yohay. It says, can we expect a hike rate in the ECB soon before tapering QE?
No. Easy answer is no, not in 2017. I think they'll follow the Fed, continuing to buy bonds until the end of the year, then tapering it down during 2018, and maybe towards the end of 2018, 2019, they will raise rates. What do you think, Valeria?
The same. I believe that the tapering QE is not in the agenda these days. Not maybe next year. Maybe okay. We will get some talking about it. And after that, well, maybe after they start tapering, then they will consider a rate hike. But a rate hike in euro area seems unlikely. Okay, the person that asked the question says, but negative rates are hurting banks. The Fed never had negative rates. Yeah, and that's a point indeed, but well, yes, as you say, Yohay, negative rates are hurting banks, and the Fed never went into negative territory.
Yeah, but also in very low interest rates limit the margins of banks. So I don't see. We didn't see any big bank collapse. We had a story this week here in Spain where Banco Santander bought Banco Popular, but I don't think Banco Popular reached the state that it reached because of low interest rates. I think they just had issues from the pre-crisis period. So also banks in the US did not make so much money because of lower interest rates without them being negative.
Okay, Banco Santander help or rescue Popular, right?
Yeah, with a bit of pressure from the government as well. Yeah.
Oh, okay. I didn't know that part. Okay, anyway, it's Italian banks which are under fire, but that's also an older issue that has much to do with negative rates, but with poor administration in the country, right? There's a possible election coming in Italy, but yeah, not much about it yet. It's just speculation, and it's all related to the banking sector.
Yeah, the main bank in trouble there is Banco di Pasci, Monte di Pasci di Siena.
Yeah, that one.
But also UniCredit, a bigger bank, is not enjoying huge profits. Let's put it this way. Is also in some kind of trouble. So.
Okay, here we go with another question. It's a double question that I don't believe it's related. What are the expectations for the UK elections and what's needed to see the pound rallying? You want to go first?
Okay, so maybe we'll have time for. I'll try to do a quick preview like I did in the morning show.
Yeah.
To see the quick answer is to see the pound rallying. We would need a landslide victory for the Tories, for the Conservative Party.
Majority in the parliament, right?
Yeah, but a big majority, something like, I don't know, 360 seats, something like that. Markets want Tory landslide. Why? Because they believe that if Tories, the Conservatives, win a landslide, they could have a softer Brexit. Okay, because you will not have internal opposition. Markets don't worry so much about external opposition, but internal opposition within her party. A narrow majority, what she has now, means more pressure from the Brexiteers, and it could hurt the pound. Markets don't like Labour too much. First of all, it's not different on Brexit, and this time the leader of Labour, Jeremy Corbyn, is truly left-wing. There's a big difference between the right-wing Conservatives and left-wing Labour. Usually the differences were quite small. And I would just say that, in general, I would expect watch out for turnout during the day. We have many more hours of trading until 9 GMT, until the exit polls. A higher turnout is better for Labour, bad for the pound, because younger people usually turn out to vote less than older people, and they vote more Labour. Low turnout means that the strong and stable old people that vote Conservative are out to vote, and that's positive. In general, if it's a landslide majority, the pound rises. A narrow majority, I would say the pound is stuck in even falls. The UK economy is slowing down. Brexit is here. And if we have a hung parliament, no outright majority, we could have a big fall in the pound, 300, 500 pips. And but later, let's say if there's a government that includes the Liberal Democrats, which are very, very much pro-Remain, then perhaps after the big fall at the beginning, this coalition government will have a softer Brexit, and that could be, of course, more positive for the pound. Anyway, it's going to be a very long night because elections in the UK are always slow, and they count things very slowly. So it's going to be a long night, some of it on very thin liquidity, especially the exit polls. Then we'll have Tokyo coming in, and of course the full reaction in Europe at the beginning. It could be quite busy.
That's one thing I would like to add, guys. I'm bringing up the euro-dollar daily chart just because to remind us all what happened with the U.S. elections, right? We were all waiting for Clinton to win the election. Trump, the euro-dollar rush higher with the dollar collapsing all through the board, reaching 113. And 2 weeks later was nearly 1,000 pips lower, right? So beware of that. Beware of the immediate reaction. Beware of this kind of wild 400, 500 pips moves one way or the other. Now, the market will give us plenty of opportunities after dust settles, right? So don't rush into pound today, okay? And if it's bullish for pound, I would like to take a look. I will be taking a look at the GBP CAD because the Canadian dollar is among the weakest today because, of course, of falling oil prices, right? But beware, guys, beware because we have wild safe side of the board, and that spike was 113 less than an hour, if I'm not wrong. Right? Settle around 900 that day, so. It was a rush. I do believe that the outcome of elections is one of the most unpredictable things we have. Polls ahead of elections, right, are giving us a lot of failures lately. So beware of that. Beware of the final outcome.
Yeah. This time, I think that some brokers did limit their leverage or things like that, but most brokers didn't make big changes.
I got a couple from brokers that changed leverage of elections. They have become extremely cautious after the peg in between euro and Japanese. Yeah. It still hurts, right?
Yeah. Yeah, some brokers went bust, some became zombies. The whole industry was affected. It happened nearly 2.5 years ago.
Yeah, over 2 years ago, yeah. I was thinking that. I was remembering that, yes, today. Okay, the euro keeps hissing.
So it's sort of a buy the rumor, sell the fact on this removal of lower rates, would you say?
Yeah. So we have to wait some 30 minutes for Draghi to start speaking. Remember that we will have some US data alongside the usual jobless claims at the same time. I was seeing that the GDP for the first quarter was released higher in the euro area. Quite good news. Although, as long as Draghi decides to deny discussing quantitative easing, positive numbers will be little for the euro, right, Yohay?
Sorry, I didn't. What?
I said that we have an upward revision in European GDP today, but if Draghi continues with his stance of maintaining QE until the end of his mandate, as he more or less have said multiple times, positive data will be little for the euro.
Yeah, Draghi had the same stance of acknowledging higher growth, diminishing downside risks. Still downside risks. This could change today, but each time when you talked about inflation, that's already a different story. Inflation is still less subdued and more cautious. We still need to continue with our monetary accommodations. So it's sort of two different worlds. So, as you mentioned, today we had better than expected GDP and upward revision, but last week we had the downgrade of inflation figures to 1.4 on the headline, getting away from 2% or a bit below, and 0.9 on the core. That was a disappointment after it reached the highest level since 2003. It reached 1.2. Once again, a setback. So that's how he can balance his words.
Okay, someone's asking, what's your take on gold? Well, gold it's now easing short term following the euro weakness and a bit of lower demand, but overall we are standing close to 1300, right? It's a major resistance, but gold is more dependent on the greenback and the dollar strength or weakness rather than whatever happens in Europe. So most of what will happen will depend on how the market reacts to the economist's testimony in the short term, I mean. And for the longer run, as long as the US data keeps missing expectations or being soft, not bad, but soft, chances are towards the upside longer term, right? Today, I'm watching that this current 83 region, in fact, a few cents below where we are now, we have a relevant high, right? So I believe that if we lost 83, 82, we can go down to this low around 77 and even lower towards the 74 or so, but not expecting large moves. Short term seems poised to correct, but let's see what happens with the greenback today.
Yeah, I noticed yesterday that gold was influenced by Comey when the statement was released, and we learned that there wasn't anything new. Gold fell. But, let's see how gold and dollar yen, for me, the biggest movers, will react to this actual testimony.
Okay, so far the euro is but held above 112. So not much there. As long as it holds above 112, room towards downside is quite limited. There are a couple of supports, 1160, 1120. I do believe that even 110.80, which is a strong low for a couple of weeks ago where the pair bounced back, it's the level to watch if we have huge moves in here, because only below that level the pair will be ready to correct lower. I'm still not talking about bearish trend, right? I'm talking about a correction. If you take a look at your charts, the euro dollar has been pretty much consolidating and offering little beyond that range, right there. So that 1080 low, it's for me the most relevant one, because if we lost it, then there's a good chance that the movement will be towards the outside. And towards the upside, I will be going back to my long-term charts. If you draw a line around 1460, right, you could see that the pair has been healthy. Very limited exceptions and short-lived ones. Been rejected from there since January 2015, 2 years and a half almost. So that's my main bullish target in the case of a wild bullish run beyond 13. Someone's asking. Yeah, go on. So.
Looking at the top level 112.84, if Draghi really goes bullish, and let's see if it breaks the cycle high.
Yeah, I don't see much of a case for a huge move, but well, we don't know. There's another question saying how far oil can go down. At this point, I do believe 42 is the first line in the sand for me. It's like a strong long-term support area, 42, 42.50. And to be honest, I can't see prices falling below that level. But if market sentiments continues to be that negative towards oil, then there's a good chance that we go down towards 37, 38. But still, it's a very limited opportunity. I do see the 42, 52 range as being the average price of oil. The levels that have kept leading price action for most of the past year and a half or so, with movements beyond that area being quickly reverted. So that's what I'm looking for to persist in oil prices. Still, it's bearish, and there's a good chance it can break lower.
Yeah, let's see. Dollar into defensive. Also, yesterday when the report came out about the lowering inflation forecasts, you've seen the reaction that at least volatility is back.
Okay, not much to go, guys. Hoping market will wake up on Friday and provide us much more next week. Okay, someone's asking, what can we expect from Draghi today? What can we expect from Draghi today?
Oh, you can expect him to, first of all, at the beginning of the statement, to say that risks are balanced. That will be a move towards the hawkish side, different than what we've heard from him so far, that risks are tilted to the downside, more downside risks than upside risks, because growth is rising. On the other hand, he will not give us any information, and reporters will ask him about QE tapering. That decision will probably wait for September. This is the baseline scenario. In this case, I expect euro to move a bit up, a bit down, not do anything, not go anywhere fast. And in the longer run, the trend remains to the upside. If he does give us some details about QE tapering, which will be very surprising, euro will go up. And if they don't change the assessment about downside risks, or if he's very, very pessimistic about inflation, then the euro can fall. That's how we see things.
That's okay. Yeah, I agree with that. I was thinking that we are having right now the elections and all the excitement around town is focused on that. But let's not forget that once that's settled, Brexit negotiations will start in 11 days on June 19. So the market focus will shift quickly towards Brexit negotiations. And there we have the euro area wanting the UK to pay Brexit with some estimates on around 100 billion pounds or euros, I'm not sure. But anyway, an amount of money that the UK is not willing to pay. Therefore, further conflicts will arise then, no matter how the election result for the pound in charts. Brexit will be next and will probably be pound negative, right? So take that in mind when you take your trades, at least long-term ones.
Yeah, we've seen already UK growth slowing. The first 2 quarters after the EU referendum, the UK economy continues growing very nicely, 0.6, 0.7. In the first quarter, it slowed down significantly to 0.2. And the weaker pound pushes inflation higher. Real wages are falling because inflation is higher than the rise in nominal wages. So standards of living are falling. UK consumers are buying less. All in all, the picture is not so bright, especially if Theresa May gains a small majority and continues with a hard Brexit. If she gains a huge majority, there will be hope for a softer one. If there is, any kind of government that is more pro-Remain, or Remain, they won't remain, but more pro-soft Brexit, then perhaps we could see things improving. But all in all, the picture, I think, is not so good. And the Europeans, as you mentioned, are tough. They begin with a tough start with all this divorce bill.
Yeah. I do understand that your representatives won't discuss trade or anything else until the bill is settled, right? And the UK is just focused on getting the best possible deal on trade, right?
Yeah,
or the
future.
Makes work. So I don't know. That's a big conflict for me, and that's a big no for the pound. But well, we have to take a look at the charts and wait what happens there, right? Okay, we are having some figures coming from Canada now, housing starts, right? But could do little for Canadian dollar.
Canadian dollar not going anywhere fast. We had the OPEC deal a few weeks ago. That was fun. And we had better than expected GDP from Canada. Can't say I see a clear trend. Well, we fell off the highs, but I'm not sure we're really going lower.
Stocks are quite quiet. Are really quiet today. Also waiting for this and quite it's the market. Yields are slightly higher. That's what's also helping the dollar yen advance. But still, waiting for Super Mario here. And
few more minutes.
yeah, for what I'm seeing around news, we're heading into the meeting and the speech, with high expectations. The fact that they cut the lower rates parts, it's somehow being taken as a positive stance and a first step towards tapering easing, right? Not sure if that's the case. We have to hear it from Draghi before confirming that. But if so, then the euro should find some demand after that. Let's see how he presents.
Yeah, 15 minutes to go.
Yeah. I'm not sure what time, or do we have a time for Carmen's testimony before the U.S. Congress?
Yes, it's 2 GMT, so at the usual time when big economic figures are released.
Okay.
But we already know what he's going to say at the beginning. He's going to read his 7 pages that were published yesterday, and then the more interesting part is
question. Yeah.
And I know it's broadcast live on many television stations in the United States. Some bars opened early. So if you're in Washington, you can see it. Or in other places in the United States, you can hang out with your friends and watch the Comey show like any sports event.
Oh, my God. Okay. So after that, we'll probably see the market settle and wait for the outcome of UK elections before gearing up again, right?
Yeah, 3 big events today, Super Duper Thursday. And next week we have the Fed.
Next week already? Ooh.
Yeah.
Are we going to get a rate hike or not?
I think, well, markets need to agree there's going to be a rate hike because the Fed told us so. That's what markets are expecting. When the poor NFP came out, they didn't do anything. Yeah, but I think it'll be a dovish hike. More, we are hiking now, but taking a break for some time. What do you think?
Yeah. Well, I pretty much agree with you in the fact that the market believes so, that the Fed will hike in June, but will double, triple, and quadruple think before moving again, particularly if that remains soft. If they don't move, this time will be a great opportunity to resell the greenback, right?
Yeah.
And if they actually do, I don't expect a huge market reaction because pretty much it's priced in, right? We all are waiting for for the Fed to pull the trigger in June.
Yeah. Back in December, it was a hawkish hike. They not only raised rates as everybody expected, as they told us, but also raised the dot plot. In March, they sort of brought forward one rate hike, but they didn't change the outlook, so it was more like a dovish hike. And this time, well, we'll have to look at the dot plot once again, see the dollar reaction.
Yeah, I guess the market is running too far away lately. So we are pricing in things that we don't know that will happen way into the future. And I do believe that the rate hike has been priced in already, and that the market feels that that's not enough at this point to buy the greenback, that we will need much more solid data before we buy in dollar. So, well, I don't know. It's my view, you know. In the meantime, the euro keeps bouncing. The rest is keeping in wait and see mode. And here we go.
Yeah, like 112.30. Yeah, so we'll be covering it live next week.
Fed, you mean, yeah, no doubts, we will be here. Ten minutes to go to hear Super Mario sharing his particular stance, hoping for a hawkish one, the market at least.
Yeah. For those of you joining right now, the ECB left all the policy measures unchanged, as widely expected, but they did remove the reference to lower rates. So the ECB told us that it'll keep rates at present levels for a long time. Beforehand, they told us that they'll keep interest rates at present or lower levels for a long time. So that's a small change of wording, but that was expected, and euro-dollar is a bit lower than before the release, or basically, no, we return to the same place, right?
Yeah. We are pretty much unchanged. Bit lower. Oil, it's low.
Yeah, yesterday we heard about the big build in inventories of crude oil were expected to fall, but they went up, so price of oil fell. So a few more minutes. I'm looking at the European Central Bank website. 8 minutes to go. They have a countdown clock.
Okay.
Like all the news networks, TV networks in the US, always have countdown to some big event. So we're going to hear soon from Mario Draghi, the president of the ECB. Less than 7 minutes to go. Till the big event, the first big event of Super Thursday.
Yeah. Canadian dollar, sorry, was below expected. Not helping much the dollar pair to change. Okay.
Few minutes to go. Let's see if we can find more headlines. It's mostly about the tension towards the ECB president speaking.
Bloomberg saying that the UK election is really about Brexit. Well, that's not news, but indeed, I agree with that.
Yeah, less than 5 minutes to go.
Yeah.
So yesterday we dropped almost to 112, and the highs were 112.84 more or less.
Yeah, and we have that peak just 12.99 in my charts. I'd said 113 after the U.S. elections outcome last November. That's the level I will be closely watching today. We are going to have leave. Draghi's words, so you will be hearing them. We will be also.
Let's see if I have anything to add about Draghi. Again, watch out for forecasts. It's going to talk about probably better growth forecasts, but more importantly for markets, lower inflation forecasts. That's what we learned yesterday from the leak. And downside risks, probably no more downside risks, but balanced risks. But that is more or less priced in. Yeah, and regarding tapering, it'll probably have to wait until September.
Well, I looking at that, he has already started setting the path towards easing. At least that's what the market believes now, that they remove the line on lower rates in the future. Let's see if the rest goes alongside.
Yeah. The QE program lasts until the end of the year, but they've already extended it twice.
Yeah.
Markets expect them, well, to extend it, but to begin reducing it, tapering down from 60 to eventually 0 during 2018. But details will probably wait until September. Okay, 1 minute to go.
Okay, yeah.
Job claims in the US are expected to fall from 248 to 240. Isn't such a big market mover. Okay, the ECB changed the slide in its live broadcast.
Okay, we're going to start. Okay, we're going to start sharing live the ECB. So we have to mute our micros for a couple of minutes and listen to Super Mario first, okay? We'll be back with the initial comments.
Ladies and gentlemen, the Vice President and I are very pleased to welcome you to our press conference. First, I would like to thank Governor Hansen for his kind hospitality and express our special gratitude to his staff for the excellent organization of today's meeting of the Governing Council. Okay. We will now report on the outcome of our meeting. Based on our regular economic and monetary analysis, we decided to keep the key ECB interest rates unchanged. We expect them to remain at their present levels for an extended period of time and well past the horizon of our net asset purchases. Regarding the non-standard monetary policy measures, we confirm that our net asset purchases at the current monthly pace of 60 billion euros are intended to run until the end of December 2017, or beyond if necessary, and in any case, until the Governing Council sees a sustained adjustment in the path of inflation consistent with its inflation aim. The net purchases will be made alongside reinvestments of the principal payments from maturing securities purchased under the asset purchase program. Our monetary policy measures have continued to preserve the very favorable financing conditions that are necessary to secure a sustained convergence of inflation rates towards levels below but close to 2% over the medium term. The information that has become available since our last monetary policy meeting in late April confirms a stronger momentum in the euro area economy, which is projected to expand at a somewhat faster pace than previously expected. We consider that the risks to the growth outlook are now broadly balanced. At the same time, the economic expansion has yet to translate into stronger inflation dynamics. So far, measures of underlying inflation continue to remain subdued. Therefore, a very substantial degree of monetary accommodation is still needed for underlying inflation pressures to build up and support headline inflation in the medium term. If the outlook becomes less favorable, or if financial conditions become inconsistent with further progress towards a sustained adjustment in the path of inflation, we stand ready to increase our asset purchase program in terms of size and/or duration. Let me now explain our assessment in greater detail, starting with the economic analysis. Euro area real GDP increased by 0.6% quarter-on-quarter in the first quarter of 2017, after 0.5% in the last quarter of 2016. Incoming data, notably survey results, continue to point to solid, broad-based growth in the period ahead. The pass-through of our monetary policy measures has facilitated the deleveraging process and should continue to support domestic demand. In particular, the recovery in investment continues to benefit from very favorable financing conditions and improvements in corporate profitability. Employment gains, which are also benefiting from past labor market reforms, are supporting real disposable income and private consumption. Moreover, the global recovery is increasingly supporting trade and euro area exports. However, economic growth prospects continue to be dampened by a sluggish pace of implementation of structural reforms, particularly in product markets, and by remaining balance sheet adjustment needs in a number of sectors, notwithstanding ongoing improvements. This assessment is broadly reflected in the June 2017 Eurosystem staff macroeconomic projections for the euro area, finalized in late May, which are conditional on the full implementation of all our monetary policy measures. These projections foresee annual real GDP increasing by 1.9 in 2017, by 1.8 in 2018, and by 1.7 in 2019. Compared with March 2017 ECB staff macroeconomic projections, the outlook for real GDP growth has been revised upwards over the projection horizon. The risks surrounding the euro area growth outlook are considered to be broadly balanced. On the one hand, the current positive cyclical momentum increases the chances of a stronger than expected economic upswing. On the other hand, downside risks relating to predominantly global factors continue to exist. According to Eurostat's flash estimate, Euro area annual HICP inflation was 1.4% in May, following 1.9% in April and 1.5% in March. As expected, the recent volatility in inflation rates was mainly due to energy prices and temporary increases in services prices over the Easter period. Looking ahead, on the basis of current futures prices for oil, headline inflation is likely to remain around current levels in the coming months. At the same time, measures of underlying inflation remain low and have yet to show convincing signs of a pickup, as unutilized resources are still weighing on domestic price and wage formation. Underlying inflation is expected to rise only gradually over the medium term, supported by our monetary policy measures, the continuing economic expansion, and the corresponding gradual absorption of economic slack. This assessment is also broadly reflected in the June 2017 Eurosystem staff macroeconomic projections for the euro area, which foresee annual HICP inflation at 1.5% in 2017, 1.3% in 2018, and 1.6% in 2019. By comparison with March 2017 ECB staff macroeconomic projections, the outlook for headline HICP inflation has been revised downwards, mainly reflecting lower oil prices. Turning to the monetary analysis, broad money M3 continues to expand at a robust pace with an annual rate of growth of 4.9% in April 2017, after 5.3% in March. As in previous months, annual growth in M3 was mainly supported by its most liquid components, with the narrow monetary aggregate M1 expanding at an annual rate of 9.2% in April 2017, after 9.1% in March. The recovery in loan growth to the private sector observed since the beginning of 2014 is proceeding. The annual growth rate of loans to non-financial corporations increased to 2.5% in April 2017 from 2.3% in the previous month, while the annual growth rate of loans to households remained stable at 2.4% in April. The pass-through of the monetary policy measures put in place since June 2014 continues to significantly support borrowing conditions for firms and households, access to financing, notably for small and medium-sized enterprises, and hence credit flows across the euro area. To sum up, a cross-check of the outcome of the economic analysis with the signals coming from the monetary analysis confirmed the need for a continued very substantial degree of monetary accommodation to secure a sustained return of inflation rates towards levels that are below but close to 2%. In order to reap the full benefits of our monetary policy measures, other policy areas must contribute much more decisively to strengthening economic growth. The implementation of structural reforms needs to be substantially stepped up to increase resilience, reduce structural unemployment, and boost productivity and potential output growth. Regarding fiscal policies, all countries would benefit from intensifying efforts towards achieving a more growth-friendly composition of public finances. A full, transparent, and consistent implementation of the Stability and Growth Pact and of the macroeconomic imbalances procedure over time and across countries remains essential to bolster the resilience of the euro area economy. And we are now at your disposal for questions.
Ms. Weisbach?
Thank you very much, Annette Weisbach with CNBC. I have two questions, of course, regarding the two big changes in the communication today. Has that been decided on a unanimous basis? So everybody was behind that? And the second question is on the forecast. If you're saying inflation is around 1.6% for 2019, so how much QE is factored in that inflation forecast? Because you're saying the asset purchase program might end this year, might also go further into next year, but how much is that, how much of such an effect is still in that forecast for 2019 and 18? Thank you very much.
Thank you. On the first question, we didn't have a vote, so I can't really say unanimity, but basically I didn't hear any dissenting voice by any governing council member with respect to the proposals that have been just stated in the introductory statement. The other thing is basically, well, we've defined our objective. Our objective is a self-sustained, durable convergence towards an inflation rate which is below but close to 2%. This convergence is predicated on the very substantial amount of monetary accommodation that I've just mentioned in the introductory statement, and it's predicated on that. That's what it is in the projections, and that's what it is in our program. Thank you.
Mr. Madiste?
From Reuters. Mr. Draghi, my question is regarding Banco Popular. Did the ECB act quickly enough over Banco Popular, given how close it came to being insolvent? And are you reviewing the case now, given the bank was deemed insolvent less than a year ago?
Now, here, as you know, we have a separation principle, and we never comment on individual institutions. But what I can say, as far as we are concerned, we can only express appreciation for the timely action of the SSM. And then if the Vice President wants to have any comment on that, I will give him the floor. But otherwise, we don't comment on individual institutions. And as you know, we have the separation principle. Please.
Yes, because, of course, it was a decision of the ECB that was at stake. That decision was based on the BRRD, and the reasons that triggered that decision were related to the liquidity problems. There was a bank run. So it was not a matter of assessing the developments of the solvency as such, but the liquidity issue. It is stated in Article 32, number 4, item C, that the fact that an institution is unable, or there are sufficient objective facts that show that is about to become unable to satisfy its debts and liabilities, that's a reason for the declaration of an institution being failing or likely to fail. That's enough. And then after that declaration, the process was given to the single resolution mechanism that then is in charge of resolution. So our role as ECB was just the declaration of that the bank for liquidity reasons was failing or likely to fail.
Ms. Jones?
Mr. Draghi, a lot of people are going to take the tweaking to the forward guidance as a sign that a decision on tapering will come in September. Would market participants and ECB watchers be right to think that we will get a decision on tapering or what happens to QE in 2018 in September? And one of the heads of, my second question, one of the heads of the national central banks has raised doubts about whether the European Central Bank can hit its inflation target. We've seen today downgrades to the inflation projections, but at the same time you have removed the commitment to lower rates. Given that, should markets share the same doubts as Mr. Novotny that you perhaps can't hit your inflation target? Thank you.
So the first question is, it was not discussed. On the second question, you're actually asking me many questions. First of all, the downward revisions in inflation. As a matter of fact, very little has changed as far as inflation is concerned, because it was 1.9 in April, if I remember, and we all remember the serious concerns, if not the outcries, for inflation was going up too much. And now it's 1.4, and it's mostly, actually almost entirely driven by the price of oil and price of foods. So from that viewpoint, nothing has changed in substantial terms. What needs to be explained, however, is the flat and low profile of the underlying inflation. And that needs to be explained in a sense. And that has to do mostly with the subdued nominal wage growth. And there are many reasons, and some of them may be more important than others. It's hard to say which is which, but basically the reasons that are behind this are certain structural changes that have taken place, one of which is certainly the backward-looking negotiation of nominal wages to looking as a sort of reference of inflation, looking at low inflation rates as a basis for current negotiations. But there are also other reasons. All this recovery is happening with a very strong creation of new jobs. And so there is definitely a very significant increase in labor force, labor participation. At the same time, we have evidence that many of the, it's hard to say what is the percentage, but many of these new jobs are so-called low-quality jobs, where we're talking about temporary employment, we're talking about part-time employment. There are many, so much so that the ECB in a recent paper has developed some measures of a broader concept of unemployment, which is broader than the official rate. It may well be that this is actually slowing the growth of nominal wages as well. More generally, structural reforms that have taken place are very good. I mean, are good for growth certainly. And are good ultimately in the medium long term for employment, but also in making the markets more flexible, especially the labor market more flexible, do tend to produce a lower growth in nominal wages. So all this makes us think that some changes in the structure of wage negotiations have taken place. However, so the first thing is basically we need to be patient. We need to be patient because we know that the labor market slack is actually tightening, the output gap is closing, and we know that all these factors in the end their effects will fade away. The job quality will improve, productivity will increase with the cyclical recovery goes up. So the second point is that so first of all, we need to be patient. Second is we need to be confident. If we look at the uncertainty dimension of inflation, we see two phenomena. The first is that tail risks have disappeared. So deflation risks are not there any longer. And that's why we have removed one of our easing biases, which was exactly addressing the tail risks of the inflation path. And we also see that the uncertainty about the path of inflation is also decreased. So as the output gap will close and unemployment rate will go down, we are becoming also more confident that the inflation path will converge towards our objective in a durable way. Now, having said that, and here I come to the other part of your question, we need to be persistent. So we need to continue to accompany the recovery with our monetary policy. We will continue with our purchases, and the introductory statement again is quite clear. We confirm our net asset purchase, the current monthly pace of 60 billion euro, and these purchases are intended to run until the end of December 2017 or beyond if necessary, and in any case until the Governing Council sees a sustained adjustment in the path of inflation consistent with its inflation aim. Also, I want to emphasize that basically the ECB will be in the market for a long time. When we say the net purchases will be made alongside reinvestments of the principal payments from maturing securities purchased under the asset purchase program. And just a little later on, we say that a very substantial degree of monetary accommodation is still needed. If the outlook becomes less favorable, or if financial conditions become inconsistent with further progress, we stand ready to increase our asset purchase program in terms of size and or duration. So the bottom line basically is that the Governing Council trusts the strength and the power of our purchase program, and that's it. I think I've responded to all your questions.
Mr. Barbera.
Good morning, Alessandro Barbera, La Stampa. Do you think that a prolonged lower inflation rate forecast could force the ECB to change its forward guidance and raise the negative deposit rates before the end of the quantitative easing?
No. Nothing substantial has happened to inflation other than changes in the oil price and the price of food. Everything stayed. I think it was well said by Governor Hanson this morning. If we compare inflation now with inflation in December, and we see that underlying inflation is basically the same for years after year. And so doesn't... At the same time, since we have stronger confidence in the path of the inflation convergence, and we've seen that the tail risks of deflation have definitely disappeared, we felt confident in removing the interest rate, the easing bias as far as the interest rate was concerned.
Mr. Speziale?
Alessandro Speciale, Bloomberg News. Mr. President, did you have during this week's meeting any discussion about policy normalization, or is this discussion still to be had in the future in the light of the current inflation outlook and of the inflation projections? And as my second question is, you have removed the so-called easing bias on rates, but you say that you still are ready to increase the size and duration of QE. Under what conditions would you do that? I mean, would a continuation of this inflation outlook warrant an extension or maybe even an increase in volume of QE? Thank you.
Thank you. Well, you asked me about normalization was being discussed. The answer is no. Of course, there are people one or two council members observed that we have to think in perspective to the link between the asset purchase program and the inflation convergence. So there were sort of actually two, if I remember, I guess. Observations of this nature, but there wasn't any discussion of like that on normalization as you mentioned. The other point was about why we left the other bias, the APP bias, easing bias. Well, first of all, the two are very...
Okay, we had Draghi and Euro falling. Are you here with? Okay. Anyway, I believe that we can take out a couple of interesting things from this meeting. As largely expected, the ECB left rates unchanged and record lows. While Draghi press conference, it's been focused on reaffirming the need of maintaining QE. Hi, Yohay, you're back. Okay.
Yeah.
I was saying that on the press conference, it's focusing on reaffirming the need of maintaining QE. Draghi is concerned about inflation. And as we heard on Wednesday, the ECB downgraded its inflation forecast, although recognized that the economy is showing a stronger momentum, right? The euro fell, but it's not that much. There was a key headline removed, a couple of words being removed, right? The possibility of lower rates in the future. And I guess speculative interest is hanging on to those words as a first step toward easing, right? Draghi don't want violent moves in the euro. Draghi don't want a more expensive euro, and therefore he's taking baby steps towards that easing that we are waiting for. So that's my take on this decision. Also, and despite it, I take it as generally dovish, right? Because despite removing those words, he's still quite concerned. We said that the easing was not even discussed. The fact is that the euro is holding around 12.20, mostly also because of broad dollar weakness, right? No one wants the greenback. There's no love for the greenback these days, guys.
Yeah. So he managed to balance between growth and inflation, but it was a bit tilted to the downside. So speaking of downside, as expected, they removed downside risks and also moved lower rates. That was already in the initial statement before the press conference. Another positive thing he said was that tail risks are gone, and of course, the upgraded growth forecast. The negatives were that he's worried about inflation. He also even said nothing substantial has changed about underlying inflation. So it's basically the same core inflation. And I think the only more significant negative surprise in the forecast was yesterday we heard that all the inflation forecast for the next 3 years, 2017, 18, and 19, will be at 1.5. And for next year, for 2018, it was downgraded to 1.3. So that was a negative surprise. For this year, it's 1.5. So it's basically upgrading of growth, but downgrading of inflation. And, well, now we're back to square one, to 112.30. But I see it more as dovish Draghi than...
than what the market wanted, right?
Yeah, but look, again, upgrading of growth, downgrading of inflation, the end result, big move in, quite a bit of volatility, but we're back to square one, so I think it's roughly balanced. Where do you see euro dollar going after he finishes talking? I mean, we have Comey, actually.
Okay, we have Comey in the way, and if that's dollar positive, we can go down to 11.60 or so in the American session. But honestly, I'm not seeing much of a case for a dollar rally. To be honest, I could expect it to rise back, hold around its range, 12.13. Maybe UK elections can paint a clearer picture about the euro or the dollar or whatever, but not getting much hopes of large moves after this statement, right?
No. We have to think. Sorry?
Sorry, no, go on.
No, I mean, as with ECB, as with Comey, the big statements sort of were out in advance a bit.
Yeah.
But I hope we'll see higher volatility. Yesterday, at least, we had relatively high volatility in euro dollar. Hopefully, it will continue. If not, hopefully the UK elections, and they count their things very slowly, and the picture could change many times. So hopefully, pound dollar will go wild.
Okay, I guess this is time for us to say goodbye, guys. If you want to stay to hear the rest of Draghi's conference, you can. And that's it for us right now. For now, sorry. And see you back next Wednesday, right, Yohay? With the
Yeah, we'll be back covering the Federal Reserve, and it's an opportunity to thank and say goodbye to Mauricio in the background.
Yeah.
So thank you very much. It's been a pleasure doing these live coverages with you for quite a few years. And good luck.
Okay, same here. Thank you, guys, and see you soon, okay? Bye-bye.
And that's the sort of consideration that
Stay
is
with
at the
Draghi.
basis for the Commission recent work. The Commission has published a paper with different scenarios, and before the Commission's paper, we had the Five Presidents report, where there was a blueprint, a forward guidance. With two horizons, really. One is shorter term, when there are certain measures, certain decisions that can be taken, especially as far as completing the banking union is concerned. And then we have a medium or long-term horizons where new changes in the economic and monetary union could be introduced, but they do require a more extensive change in our treaties, in our treaty foundations. And so I guess it's to be welcome, this new work on strengthening the monetary union, especially on having in mind that we need to repair the fragilities that have appeared in the last few years in the union. Then we can discuss, what we talk about, but this is a broader discussion. It's not finished yet. It's just the beginning of a broader discussion. Thank you.
Mr. Ferles?
Thank you. Tom Ferles from the Wall Street Journal. Mr. Draghi, does what you said about removing the rates, the easing bias on rates, mean that this wasn't a first small step away from stimulus, a first step towards the exit, as it might be interpreted? The second question was on how constrained the ECB is likely to be on implementing QE next year. Do you see any problems, and how flexible could the parameters of QE be, like the capital key, for instance? Thanks.
On the first question, we removed the interest rate bias because the tail risks on the future path of inflation have disappeared. That is to say, deflation risks have definitely gone away. The lower the possibility that the DFR deposit facility rate could go lower was predicated on the strengthening or the materialization of these tail risks. So that is and as I said, does it imply anything as far as a reaction function is concerned? The answer is no. If things were to turn out in a way that these risks were to reappear, we'd certainly be ready to lower rates. So that's the explanation. On the second point, the program is running smoothly. And as far as the future is concerned, the program has enough flexibility. And we'll certainly look at that when the time comes, if need be. In the meantime, the Governing Council members reiterated their confidence in the strength of the program, in the power of the program, and as you've seen from the introductory statement, they confirmed both the program and the forward guidance that's associated with that. Thank you.
Ms. Mastroboni?
Tonia Mastroboni, La Repubblica. Given the fact that the ECB is exiting very slowly the period of extraordinary measures, do you think that this might be a challenge for some countries that have still a big debt like Italy, given also that Italy is facing now probably a period of political uncertainty or instability? And my second question goes to the risk. Is there a risk, in your opinion, of a scarcity of German bonds in the next time on the markets as you're going on with the same rhythm? Thank you.
Thank you. With respect to the second question, I kind of answered an almost similar question a moment ago, namely, the program is running now smoothly, and when and if we'll face problems, we'll use the flexibility that the program itself embodies. So that's the present situation. And as I said, the Governing Council members reiterated their confidence in the strength and the power of the program as it stands today. The other question, which was the first question, well, first thing to remember is we have a mandate. Our mandate is specified in terms of price stability. It's not specified in government budget support or other considerations. We have, it's been said that we have, that savers are being affected by our program, banks are being affected by our program, banks' profitability is being affected, now it's government's budgets. Second, there are always countries that anticipate, countries that lag behind. So our program has in mind price stability, and that's what we have to remember. But certainly, those countries which have a weak budget position and low growth and lack of structural reforms will be certainly more affected than others by a possible increase in interest rates. This is no discovery about that. The key thing here is to resuscitate growth is the most important thing. Thank you.
Mr. Lacour?
Jean-Philippe Lacour, French agency AFP. Mr. Draghi, on the sum-up sentence of your introductory statement, the mention with undue delay was dropped regarding the sustained return of inflation toward level close but below but close to 2%. Is it just a formal change, or what is the merit of this dropping of without undue delay? That's the first question.
It's purely formal.
Oh, purely formal. Okay.
Yes.
I have another more broadened question. Since very much attention has been given to the assessment regarding the risks surrounding the growth, economic growth, and in the past until end of 2014, if I remember, the Governing Council communicated itself also on its view regarding the medium-term outlook for price developments, and so the risk regarding this medium-term outlook. So is it something the ECB could maybe emphasize at new, or because this is an aspect which are the risks on the medium-term price stability, which everything depends on. So why this element of communication disappeared, and is it not now or in the future time to reactivate it?
We didn't have a discussion of when and if to reactivate, but certainly it's a topic which from time to time resurfaces in our discussions. And so it was raised this morning. It was raised in other meetings in the past. We are reflecting on it. There is no specific reason to have it introduced again, but we are certainly reflecting it also for sake of symmetry with the growth and with the growth of output path. Thank you.
Mr. Craig? Mr. Craig?
Thank you. Roman Craig from Ärileht. Which conditions should be met before ECB could stop offering extraordinary monetary policy measures?
The answer is really, it's defined in our objective. We have to be confident that the inflation rate is durably converging towards our objective of an inflation rate which is close but below 2%, and it's a self-sustained convergence. In other words, it's durable, but it's also going to stay there once we withdraw the monetary policy support.
Mr. Jakish?
Klausner Jakush, ARD German Television. Mr. President, I would like to touch on the 4 preconditions you mentioned early on this year, which are necessary in order to get back to a kind of normal monetary policy. If I look at the revised inflation outlook, which is really less favorable than the last one, what is your expectation? Will we actually see within the 3-year period any going back to a normal monetary situation? And secondly, if we look at this and we see that the economy picks up quite significantly in some countries, at the same time we have the fact that headline inflation is not picking up as we perhaps also would expect it, don't we have to start thinking about whether the 2% target is still an appropriate one? Thank you.
Thank you. The 4 conditions, are in the definition of our objective, which is a durable, self-sustained convergence of the rate of inflation towards an inflation rate of close but below 2%. So that stays there. That's our objective. It's not employment, it's not growth. Certainly, the stronger is the recovery, the stronger is the decline in unemployment rate, the more confident we become, as we did today, that the convergence is on its way to actually satisfy the conditions that I mentioned in its definition. That's what. Second point about inflation, I said it at the beginning. Nothing has substantially changed as far as inflation is concerned. We have to. There is going to be also in the coming months, by the way, a significant amount of volatility due to oil prices and food prices, but the underlying inflation is basically staying what it is today. So it's pretty, what we see now, based on the current information, is a path of low inflation, underlying inflation, and flat across time. You feel it? No.
We're going to have to close the press conference a bit earlier today for logistical reasons, and I'd like, as a sign of appreciation, to give the last question to media from our host country, Mr. Oya.
Tõnis Oja, Estonian Daily Postimees. Economy started to improve nicely. Is it because of QE or despite of QE? Thank you.
It's because of QE. We are here because of that. QE has supported the recovery throughout. Let me just give you a few numbers to answer your question more fully. Just said that, by the way, growth has been just revised from 0.5 to 0.6% in the first quarter. And so the annual growth for this year is going to be projected to be 2% rather than 1.9. But also, if you look at various indices, the PMI, which is an index we use to assess the state of the economy, is now at the highest level since April 2011. The economic sentiment index, it's close to the level it had in 2007, which is an all-time high. The unemployment now it's 9.3%. It's the lowest since March 2009, with all the qualifications that I've made before about having a broader concept of unemployment as one of the reasons why we don't see much growth in nominal wages. And 5 million jobs have been created in the Eurozone in the last 3.5 years. More jobs than anywhere else in the world, I think, certainly more than in the United States. So the risk of deflation has dissipated. The recovery is proceeding based on consumption and consumption and investment are growing because of QE also, not only, but also QE, because oil prices are, or because interest rates are low, labor income has increased, households' wealth is also increased. Financing conditions remain extremely favorable. So, and this is essentially because of QE. And the pass-through of our monetary policy decisions has probably never been so effective as it is today. So this is passed into lower lending rates, much closer spreads across the Eurozone, closer spreads across sectors and between different companies. I think I've said in the introductory statement that the SMEs are also benefiting greatly from the QE policy and from our monetary policy measures. So I think I've answered fully to your question. Thank you.
Thank you very much.
Okay, guys, thank you very much for your attention today. It has been the ECB live coverage. You are going to be with FXStreet next Wednesday to the Federal Reserve, to the Federal Reserve interest rate decision. It has been a pleasure to work with you. Thank you, Valeria, and thank you, Yohay, for your kind words. And see you next time. Peace.